Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about double diagonal backtesting and scanning. Matt, do you want to share your screen and get us started by going over our current positions?
Sure. Double diagonals. So
Yes.
that's a it sounds complicated, but we get a lot of requests for this. So very cool strategy and interesting to think about. All right, so we could go to our trade journal. This is going to be out probably by the time we hear about it, Tyler. And we've got a new thing for interactive brokers, and we're going to go to other brokers where we could upload old positions there, so you can see how you've done.
Yeah, that's going to be really, really neat for those with live trading accounts on other brokerages.
Yeah. So what did we do, Tyler? We skipped last week, right? And
We did.
So that was the 25th. So the 18th, we'd have something on in the morning potentially.
Yeah.
We could go back and check it out here. So that's quite cool. Was it a gold long? So 18th, sorry, 18th at 10:21. That looks like about it right there, right?
That was the 18th of Feb.
Oh shoot! Thanks for putting me in the right month. So
that was probably the last trade was the 11th of March. So
okay.
3 weeks ago.
All right. So yeah, we just did a lot. Oh yeah. So the market was kind of crashing, and we said, well, it's probably too late to buy a put, but you could do a calendar. So we did this calendar for way out of the money, and it's basically breaking down $50. So you purchased it, vol was kind of high, and you're about break even, but you've had that protection, so you've paid for the insurance there. All right. So shall we talk about double calendars?
Yeah, let's do it. It's a strategy that we've discussed on the show before, but we want to keep diving into it because we get a lot of questions about them. And I want to reiterate that this show is a place for discussion, and so anyone watching, please leave a comment. It is a live show, so we'll address any comments that you guys have. So yeah, if you've reached out to us with any questions before, feel free to ask them on the show, and we'll try our best to get to them.
Cool. So I misspoke. I said double calendar, but we're talking about double diagonal. So a double calendar has equal strikes. So you'd usually do it, because if you do just a normal call calendar, you want the stock to go up and expire on the strike.
Right.
And so that's your long. And if you do a put, you want it to go down to your strike and expire there, so you're short. You want it to go down. So if you want a more of a neutral strategy, you would do either right at the money, or you would do a double calendar. Now that's double calendar. Double diagonal, now you can the diagonal just means that the strikes don't have to be equal. So you could put it either way. I mean, I've seen some diagonals where the farther term is actually closer to the money than the outside ones. So the diagonal just means that it's a different expiration and a different strike. Is that clear enough, Tyler?
Right. It's funny that there's kind of a name for that, because you're kind of at that point you're kind of just trading a bunch of different options at the same time.
Yeah, it seems like it, but there's a method to the madness. So I've had a double diagonal here. This isn't the greatest example, but it's something. A diagonal is good if you want to. because you don't want to be selling like strangles naked. There's, if you have a strategy that's a naked strategy that there's a risk of ruin, it isn't really a strategy. It's just hope gambling. But if you have a strategy that has units against it, and units could be an option. So if you're short a put, you're long a put somewhere, or if you're short a put, you're short 100 shares somewhere against it. Or not somewhere, you're short 100 shares against it. So that would be flat units, and that would be something that is a somewhat protected strategy. So one of the things you can do if you want to sell strangles, and the long-term volatility isn't so high, you could buy something very long. So this is kind of so this strategy right here, Tyler, it's quite long-term. It's kind of like two very separate. Yeah. Two separate strategies, but you have something, so, like if I click on one of these, it doesn't even show up, the strikes are so wide, it doesn't even show up in the distribution, but, you have something. So, you're, in this case, you're short, you're short today, basically. And, ORATS shows 1 DTE, old school when we started, there were only Saturday expirations. So people talk about 0 DTE, but we have a 1 DTE, one goes to 0 and that expires. So that's how we term it. Anyway, so this is today. So you're selling a strangle today, but you still have something way out there. And the theory about these things is, there's really very little theta in these options. So if you're doing the 400, there's like very small theta in that particular option.
I'm guessing you're gonna try and make this 1 DTE sell this strangle every day, and basically just pick up money up until you hit that the cost of the debit spread on the other half, and then
or you could just get out of the debit spread at some point, so like if you look at my positions, I have a bunch of worthless strangles on that I have those strangles open, and then I could then sell straddles or strangles against it. So that's the theory. So this is, that's one form, but let's just clear all the settings here, and we'll just do it on a typical typical IWM, and we have strategies, but we don't have that double diagonal, and kind of the reason is like people like to do their own double diagonals. So let's see if we could try to figure out how to do this. So this is our scanner. Later on, we're going to go in and look at the backtester and see how to set those up. But let's go in the scanner first. So let's do it shorter term. So let's do 5 days or 9 days. And so we're going to be long a call and short a call. So the long call, we want to be longer term. So we want to do we'll just say 14 days, we'll say 7 or 22. So on the long, again, for the put, 14, 7, 22. All right. So, and then on the deltas, we'll just go a little bit more out of the money, but we'll just go 25 deltas kind of for all. So you okay so far?
Yep.
So what we're going to do now is we need to set a DTE diff. So we control, like if you mouse over, you could see that you're controlling the days. So right now the assumption is 0, 0, but that's not what we want. We want leg 1 to be more, and we want leg 3 to be more. So leg 1 to be more. So we're going to have a minimum of, let's just say, 2 days, and then on this difference, we're going to leg 2 versus leg 3. We have to set that because right now it says 0, 0. We won't get any. So we have to set that. Leg 1 might be a 2 day and leg 4 might be a 4 day. So you say leg 2 minus that one is a negative. So sometimes I get confused on these, but let's see if we've got anything. So now we didn't find any, but now we're finding some. Okay. Right. So we found some, some trades. So another thing that we may want to do is set the strike width. Do we want to, and this is where you could say, hey, I want, you may want to have the long closer to the money or farther away. In this case, I want to do more of a farther away one, because what happens is if it goes up to it, both of them are going to kind of increase in price. I want to have like just more of a neutral one. So I want to have the call be farther out of the money. So this minus that will be positive. So that I'll set that. So again, at least two strikes. And then we already know that that's the call minus put's going to be positive. So now the put that we're long, we want to be, that needs to be smaller. So that's going to be the negative. So that's going to be the -2. And then this is going to be obviously 2. So let's see if that worked. You can see it scanning, and it looks like it did work. So let's take a look at. So now we can rank these. So there's a distribution ranking. I like to use the forecast. We'll ignore the smoothing right now. We've had plenty of other videos where we explain this. Risk reward, we'll leave that there. So I love having theoretical values to help us out and find this. So smoothing, you kind of want it to be like less than 1 for the IWM. So this one's probably too wide. So I'll say -1 and 1 will be my ranges, and I filtered that one out. So you cool with that so far, Tyler?
Yeah, so far, yeah.
All right, so this is kind of what I'm looking for. A low-priced, double diagonal, not a lot of risk, and I'll show you what I mean by that. And so it kind of looks like this. The risk is out here. So if this totally tanks or totally goes up a lot, it goes through all the strikes, and then you're kind of stuck with the difference of the strikes. So if it goes way up, I know I'm going to lose. So if it goes to 210, the 205s and 203s are going to be 100 delta basically. And so we're just going to lose, since we're short the lower strike, we're going to lose the difference, the $200. And we're not getting credit. So we're paying. So we lose $200 plus the $25. It's 0.25 times 100. So we'd lose 225 on the top up here. And so if you look, that's kind of what this says. As we go out farther, that you're going towards that asymptote, which is negative to $225. Does that make sense so far?
Right, exactly.
Yeah. So this is a kind of trade that I'm okay with. Like this is kind of what we're looking for, right? If we did, if we just did a call calendar, so like let's just say we sold the 203 here. And then the 194, we bought the 194. We're going to be paying a lot more for it, right? So we're going to be paying, instead of paying $1.77, and you don't get a lot for that, right? You get, their profit's a little bit higher, but it's pretty similar.
Yeah, you're basically stretching your green area. You're stretching your area of profitability, basically your probability of profit, while reducing your risk reward.
Right. And if you go too far, we'll just go way out. Then you increase your risk, right? So,
right.
That actually gives you a credit, and so that's looking more like kind of a diagonal iron condor in a sense. But
it's an interesting balancing game. You can't go too far on one end of the extreme.
Right. But again, your probability of profit 64 here. So that what that means is, so we do a probability of profit. There's some calculations, but we have this distribution, so we can kind of just count the number of bars that are green and count the number of bars that are red. So, and that's the difference. So there's 40 or 35% of the time it's red, and 65% of the time it's going to be green. So it's going to, these bars are higher, in a distribution. So that's how we come up with that.
Yeah, and that's based off of historical stock price moves. So it's more than just a mathematical.
And we do some calisthenics too. We look at the IB at the time, so we kind of adjust the moves based on the implied volatility around the time, so we could make a pretty good distribution. And I think that's one good way to look at it. So that gives you a theoretical value. So you have something to compare it against. So I think a lot of people trade without a theoretical value, and you should always try to have some type of smoothing edge, right? So, we've talked about this before, but this is worth $1.75 with the SMV value, and I mean, look at it's a very wide market, and it's 183 at 167. You could see, so that's pretty close. I'll take these off just quickly. And I think we could sort on S value. And so it's not too bad. Let's just sort descendingly, because that's when there aren't any real bad ones. Let me try to wake this up and see if it'll sort again, and we get some bad ones here. Yeah, so anyway, it's a pretty tight market, so we're not going to prove that point too well, but the bottom line, I'll show it real quick, and it's kind of cool going to the option chain from there. As a matter of fact, the cooler thing is once you get a scan in your crosshairs here, you could go to the option chain and it'll pick it up. So it'll show you what you're selling and what you're buying.
Yeah, that is pretty neat.
I think it's really neat to visualize. Look how steep it is. So the slope has really gotten steep in IWM. That's this, look, like this is each month, and this is how steep it has gotten. So anyway, so this opens, so the SMV, that is you could barely see an orange line through the dots, and that creates the theoretical values here. So they're pretty close. I mean, that one's right on. 142 is right on too. So we draw a really good formulaic line through it. It's not there is a midpoint, but that's not what the SMV is for. Sometimes
you mentioned the slope there. Are there particular stocks you're looking at doing this on? Stocks that have a different slope forecast than the current slope, or perhaps maybe have a different IV forecast than the current IV?
Not on this one, because this is basically flat slope. I guess it's long. If the slope, since you're buying and buying, so a slope is you would take advantage of it by buying and selling. Okay. So buying, so this isn't really a slope trade.
Slope neutral, but it's more of a IV forecast trade.
Yeah, that's something that would be a pretty good show to do, Tyler, is do a show on how to profit from slope or whatever, and we could backtest on it as well. Yeah. So so I think that's enough for showing kind of what's going on and what the how to find a good one and how to set it up in the scanner. Why don't we go look at a backtest?
Yeah, sure.
All right. So here's the so the legacy backtester is where you can set up a custom strategy. So the first thing, we don't have a diagonal here, but you could choose an iron condor. So an iron condor has four legs, and you can control these legs. So you could control the days. So I'm going to do a 4-3 double diagonal. So I'm going to buy a call, sell a put, buy a put, and here are the kind of I'm going to do it like an iron condor, but I'm going to be selling closer to the money and buying farther out of the money, kind of like we did on that scan before. All right.
Mm-hmm.
All right. So how do you set it up? So an iron condor, this wouldn't work. You wouldn't get anything. So you have to set the leg relationships. So
yeah, we did that in the scanner as well.
Yeah, so you have to set that, or you're not going to get any results. So leg 1 minus leg 2. So you're going to have, that's going to be positive days. So you have to set it like a minimum of 1. There's no maximum. So that's how you set that one. And then leg 2 minus leg 3, you want that to be the same. And then leg 3, the short put minus the long put. So that's going to be shorter term. So if that's 3, and that's 3 minus 4 is -1. So -1's the min on that one. So there's the max, I should say, on that one. Does that make sense so far, Tyler?
Yeah.
And then, we could say, well, what about strikes? So, well, we know we want the longer call to be farther out of the money, right? So we want to so that's going to be a higher. So that's going to be positive. So leg 1 minus leg 2 is going to have a minimum of 2 strike points more. Okay. Strike, leg 2, obviously the call is going to have a higher strike than the put. So we set that. And then the short put is going to be higher, right, than the long put. So we're going to be long a put that's farther out of the money. So then that's a positive. So the higher strike minus the lower strike is positive. So that's how we set that up. Are you cool with that?
Yeah, I mean it's complicated, but once you get the hang of it, it starts to make sense. And it's a necessary part of the back test, otherwise it won't be right. So
yeah, I mean, you could also change the ratios. Like if you wanted to buy 2, you could have like a double.
Yeah, this is where the legacy backtester really stands out. We have
really cool.
the backtest finder and then the custom backtester within that tool. But the legacy is where you can really get into the nitty gritty of some of these parameters, like the ratios and DTE difference.
And you could set, what's your spread yield, how much you want to get, like what's the, you could set how much your option price that you want to pay or get divided by the stock price. I love using that too. So like, if we want to pay or if we want to do this for a credit even, like we could actually, why don't we just try this for a credit? And it's going to be small. So like 0.5%. And the minimum is like 0.01, and then the max is like 0.0002 or something. So
if it doesn't find trades within that range, it's just not going to trade for that day.
Yeah, and it'll look the next day.
Okay.
So we'll run that. I've already run this strategy. It only takes a couple minutes, but I've already run this on the old way. So here's the way that I ran it before, and you could view the inputs. This is the 3-4 double diagonal. And then, so we could see that it does okay. So again, this is a little misleading or a lot misleading, that we look at notional returns, and we do that mostly because we want to assess this type of trade against other trades, and just, sometimes it's overlaid with the stock, so then you could compare it. So, and we always know, and the big thing is not the absolute return. The big thing is the return divided by the drawdown or the volatility. So the Sharpe is not that great, but the Sortino is pretty good. So the Sortino just looks at the downward volatility, because you don't really care, or some traders don't care about upward volatility. Okay.
Yeah, is that called profit factor, or is there a term for that ratio?
Sortino.
The return divided by the volatility.
That's the Sharpe.
Oh, okay.
That's what Sharpe ratio is. And then there's another one that we don't use that's kind of cool. It's like a Calamar. So it's the annual return divided by the drawdown. Yeah,
that'd be nice having that.
What I would like is to divide it by the maximum risk. Not drawdown is just what happened. But some of these, I guess Buffett was famous for saying, when the tide goes out, you find out who's been swimming without a swimsuit. Like drawdown is just what happened. But if the tide never went out, then you wouldn't see a drawdown. But who's swimming without swimsuit, right? So what is the maximum risk that you could lose on these things? So if you're just selling a naked straddle, you could lose all your money on that. You could go to zero. And so that I like that kind of ratio as well. So here's how the strategy did okay. I mean, we haven't really optimized her. This is just kind of a starting point for people to start to test how they want to do a double diagonal, because double diagonals, there's so many different things that you could adjust that there's a lot of moving parts here. But and I only did it for a couple of years, but this did well in 22. It did well in 22 when the market was kind of choppy. But if the market's going straight up, it's going to violate your upper strikes. So that didn't do well, and then here it's been down so much that it's actually doing okay of late. Anyway, that's cool to watch.
So this is the back test for putting the trade on the long and the short side at the same time and getting out of it at the same time. But what about that XSP one that you showed at the very beginning with a very short sell side and a very long-term long side?
Yeah. So the way that you would backtest that, and you would backtest those as separate strategies. Okay. And then, for example, let's go look at first. Let me just show some examples of a trade, and then we'll go talk about what you talked about.
Yeah.
So here's that. SPX, the first trade. So we did a call, and so we did a call, closer to the money. It was 60, 45, 64, and we did the 90. So almost $30 out of the money, but this one's way out of the money. So so there's a fair amount of risk there, right? Mm-hmm. But and we but that's how we set this up, right? So so this is the setup on this particular one. So we did those particular, and then the put also had some fair amount of risk. So this is a pretty risky trade actually, and because of the difference in the strikes. So even though it's longer term, you have some difference in the strikes. Let's go see if that other one finished running, because that other one we set the amount of money that we wanted, like that first iron condor, so that's that one. So let's just see. This looks pretty similar. All we changed was the amount. So this actually, it doesn't even have as good of a Sortino, and the drawdown's about the same. So I'd probably prefer the last one, right? Mm-hmm. And yeah, so I mean, it still did the same trade, because this is a credit trade. So anyway, now people should know that, hey, you could also control, and you could make this a debit too. If it was a debit, then it would trade a lot closer to the then you would be getting such a credit, and it would probably be a safer trade. So maybe we'll take it. Actually, we could take a shot at that one. Let's do that. And then we'll go talk about, so here's spread yield. So let's make it a debit, right? So let's make it 0.002, so small, and then we'll say 0.001. So you're going to pay something, and 0.005. You don't want to pay too much, right? So that's what that means. So anyway, we'll run that, and we'll come back to that in a bit. So Tyler, you were talking about, let's go back to the option scanner. And you were talking about this XSP one.
Yeah, and that involves a more actively managed, because you're having to make a trade almost every day. So yeah, it seems like you do two separate back tests, one the short strangle, one the long strangle, and then combine them with the combine feature in the legacy.
Yep.
That combined feature is really, really neat.
Yeah. So yeah, for this one, it would be kind of silly to like get in and get out of it each time, because what you're going to do is you're just going to have this strangle on, right? Like, so you're going to have this long-term strangle, and you're going to keep selling.
Right.
So, so that you're right. You would do this. So it was XSP, and you would sell a strangle. Short strangle, and then you would sell it like, in our case, it's 2 days to expiration. And then, maybe we do it, 25 deltas or whatever. And then we'd only do it since they started trading. So just 2020, 2022, since they started trading, I guess it was, we'll just do. So you would then run that against a long strangle that was way out of the money, right?
Mm-hmm.
And a lot more days. And then way out of the money, right? So then you'd probably do 0.05.
Yeah. Capture everything.
Yeah. So that, and then you would probably roll that. Like if it got too out of the money, you'd probably roll it, to keep it in the money. So if the delta got too crazy, you would roll that. And anyway, so maybe the easier days, way easier way to do it is to say, I'm going to hold it, I don't know, like 90 days or something, and then roll it so it doesn't get too far out of the money. And that's kind of a lazy way to do it. You probably do it by delta, like if it just went way out of the money, or you could do percent of the market, like so how far out of the money it was is kind of how you would look at it. So anyway, that iron condor where we're paying for it came back, and actually the annual returns are lower, but the Sharpe's a lot better, and the Sortino is really good. So, so this kind of, and it doesn't look like it traded that much either. And I'll tell you why. So what we should have done is we should have changed our deltas, because we're trying to pay, but we're not giving it a chance to trade. You know what I mean? Like, so.
Yeah, that makes sense. I was wondering about that, because we switched the target spread yield from a negative to a positive, but didn't change the deltas.
Right. So so we'll rerun that. So we didn't give it much of a chance, but still that looked pretty good, right? That iron condor. Yeah. So I mean, we could stay here forever, but like, this is the cool thing. I've run an ungodly amount of backtests here, looking at certain things, and I favorite a lot of things. In this particular account, I have short puts that I like, long puts that I like, and run them against each other. Mm-hmm. So then you could, find certain strategies that work well together. But anyway, I think that's a good, I think it's a really good lesson today, Tyler, about double calendars and double diagonals, where what you want to do is you want to start to think how you want the trade to be set up, how much risk you want to take. The risk is generally the difference in the strikes. We talked last time when the market was really going down, we did a way out of money put calendar, right? So those are, so that does well if, longer term, if the stock goes down, the longer term put is going to explode in value. But you could also do it where, it's almost like premium neutral. So that's a diagonal. So there's some risk there, but when the whole thing expires, you're hoping to have some value left in the long side. So we are getting some results here. For some reason, that short strangle didn't do very well, and the long strangle didn't do very well. So it's not Again, I did it one day, way out of the money, but so this wouldn't be that good to combine, but this is just a example of a particular trade. And if you wanted to combine those two, you could say, okay, well, I want that short strangle and I want it with the long strangle, and the long strangle is supposed to lose money, but the short strangle, it's been so volatile lately. But you could combine these, and I like to do it just one by one or half by half, and then submit, and that will run. And you can see how well they do combine. So that's another really cool thing about the legacy is you could combine these to see what a portfolio might look like.
Yeah, it's very neat. I'm curious. I want to see if there's a way for us to get this XSP to work, because I'm pretty fascinated by that strategy.
Yeah.
But yeah, there's a lot you can do with double calendars. Yeah, thank you for showing all that and demonstrating the tool.
Yeah, and then we don't just leave you at the backtest. We have a good way for implementing it, and it really is, I find it very hard to run a business and trade, but this makes it a lot easier to do that. To send this directly to our paper trading, or send it to the various brokers that we tie into. So it's and then you could set up alerts, and so it's a pretty nice way to trade, Tyler.
Yeah, it's very great. If you guys want to sign up, you can just go to ORATS.com and look up the trading tools and get a trial for it.
Sounds good
to get started. And yeah, you can integrate with Trader as well if you have a Trader brokerage account. And we also support several other brokerages too. So. All right, well, that's we're about out of time for today, Matt. It went by quick. Yeah, thank you for showing it. If you have any questions, you can reach out to us via email, or we answer questions on the show. We didn't get any today, but if you guys have any questions, leave them in the comments. We're always happy to answer any of those. We have resources on our website as well, ORATS University, and we have an AI chat agent if you guys want any immediate questions answered. Yeah, if there's nothing else, Matt, thank you for showing this today, and thank you, Trader, for hosting, and we'll be back again next week.
Yeah, no, I think that's great. Thanks, Tyler.
Thanks, Matt.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.